I'll be going through with your Starbucks stock. Just type it in Google and click enter, and you'll get this information. And you can see the name Starbucks Corporation. That's the name of the firm, and the symbol is SBUX. And if you want to buy right now in 2nd of August, you have to pay 95.38 US dollars for one stock. And it's in billion, the market cap is in billion, which means the firm is big, which is brilliant, and it's paying 1.51% dividend. Any company that is paying dividend, that means they're financially strong, and because after paying their costs, liabilities, loans, creditors, they still have extra money left. That extra money they pay to they pay to shareholders as dividends. So it means they're financially very strong. So it's a brilliant sign. So don't worry that even if the dividend is a low percentage, please don't worry, because it shows that they're financially strong. Now let's see, when was this founded. It was founded in 1971. You can just simply go to Wikipedia, search this box, and you can see founded 1971, 48 years ago. That's brilliant. And let me go back, and I want to see what the employees have to say about it. I'll just copy this exactly and paste it here. Type Indeed reviews and click Indeed, and let's see what employees have to say. We can see we have 35,000 reviews. That's plenty of reviews, and it's 4-star. That's brilliant. And just read through the pros and cons yourself, what people like about it, what they don't like about it, and stuff like that. And please check the salaries they're paying. Starbucks is paying, the photos of Starbucks inside of it, the jobs they have listed, and the questions, and to get more insight. Now let's have a look at the Glassdoor reviews as well. And I just want to point out we have 23,000 reviews in Glassdoor. That's brilliant. And it's 3.8 star, nearly 4 stars. That's brilliant. And please go through the pros and cons yourself, and any advice they have to give to management or whatever. And please see the jobs listed, the salaries they're paying, the interviews, the benefits they're giving, the photos of the firm, and everything, to get more insight. Now let me go to Yahoo Finance, and let me see what the key executives are getting. Let me paste that. Now if you are confused which one to click, please just go to Google and you just see the symbol from Nasdaq. You can see the Nasdaq symbol, which is SBUX. So click SBUX here, and then go to profile, and then see the sector, industry, and the full-time employees. Okay. And the best part of this firm is that it has shown all the salaries of the key executives. That's brilliant, because it hasn't hidden anything from us, and it builds trust. So we have all the salaries. We can see all the salaries of the executives. That's brilliant. Now let's go to Justia Patents, and let's see the patents this firm has. So I'll just simply paste here and click enter, and okay, and I just want to make sure that I'm not interested in inventor, because these are people who invented but they don't have full rights. I'm interested in applicant or assignee, because they have full rights of the patent. And secondly, I just want to point out that you might be worried that, okay, we are searching Starbucks Corporation, but here it's written Starbucks Corporation DBA, Starbucks Coffee Company. So it's a different name. So please don't worry, you just copy this and paste it in Google. And if you just go to images, you can see that Starbucks symbol comes. So that's part of Starbucks. That is Starbucks. So don't worry about that. So you can see the patents in 2013, 2012, 2012. That's brilliant. They have many patents. It's brilliant. But I just want to point out that please have a look if they have any patents in 2015, 16, 17, 18, because that means they're still innovating. So we need to have a look at recent patents as well. So 2016, that's brilliant, and so on. Go through the list yourself. There's a big list, and there's another pages and stuff like that. Go through it yourself. And the more patents a firm has, the more stronger it is in the market, and it has a strong presence. It's hard to beat this company. That's brilliant for the firm. So please have a look. And now lastly, I want to go to macro trend, and I will show you about some ratios. Go to price ratio and price book ratio, and I just want you to go to Starbucks, and I'll explain you briefly price book ratio. If the price book ratio is less than 1, that means that the stock is undervalued, it's cheap, it's a discount, it's a sale, you must buy it right now because it's very cheap. If it's more than 1, that means stock is expensive. The higher the number goes, the more expensive it gets. Right now it's 0, but I'll explain you why it is. If I just go to 2019 June, I can see a minus 23.42. Now it's minus because the book value is minus, so that's why there's a minus sign. Otherwise it should be an absolute number. Absolute number means that there's no minus or pluses, it's just a positive number. and it says that if somebody who have bought in June 2019, they bought the stock 23 times more expensive, because if you just see vertically up, you can see that they paid $83 to buy something that was minus $3.58 worth. So it was very expensive, 23 times more expensive. If I see in 2018 September, if somebody bought that time, they bought 62 times more expensive stock, because they paid $56 to buy something that was $0.9 worth. They paid 62 times more expensive they bought. And if I see in 2008 December, somebody who bought that time, they bought it for 2.3 times more expensive. They paid $4 to buy. They paid $4 and bought something that was $1.75 worth. So they bought 2.3 times more expensive. Although it's expensive at that time, but right now it's a lot more expensive. So you need to be careful when you want to buy it. Maybe you want to wait for it to come down. It's up to you to decide. Now let's have a look at other ratios and look at current ratio. Current ratio will tell me if the stock is risky or not. If it's less than 1, that means that the stock is risky, because there are more liabilities than assets, which is not a good news. If it's 1.5 or more than that, that means stock is safe, because there's margin of safety. You must buy that time. Let's have a look. Right now it's 1.3. It's a little bit less than 1.5, but although the assets are more than liabilities, but still it's not safe, because the margin of safety we are looking at is 1.5. It's less than 1.5. Let's look at the previous consistency. In 2019 March, it's less than 1. That means that the liabilities are more than assets, and it's not a safe stock in March. Let's look previously. Okay, so in 2018 September, it is more than 1.5, so it's a safe stock, but there's no pattern to it. There's no consistency. Like if I go back again, a few months back, it's still less than 1.5, so there's no consistency. It's a dangerous stock. It's a dangerous stock because there's no consistency in it. And if you just go back, it's like, it's rarely 1.5. So just for a while in between, in 2011 and 12, it's more than 1.5, but before that too, it's less than 1.5. There's no consistency, so it's like dangerous stock. If I go to debt equity ratio, I want to show if this will tell me if the company is operating mainly on debt or equity. And I'm looking for 0.5 or less than that for it to be brilliant. Right now it's in minus, because the equity is in minus, and the long-term debt is a lot more than equity. So the ratio is always positive. It shows a minus sign because the equity is minus. So it says the ratio is 2.58. So which means that the debt is 2.58 times more than equity, which is very dangerous, because the company has more debt than equity, and the company is operating mainly on debt, and this is dangerous. We are looking for 0.5 or less than that only. Let's look back. So it's operating mainly on debt. In 2018, it's operating mainly on debt. So let me see if it has ever been 0.5 or less than that. Yes, it has. So I can see that since 2005 up till, I would say, 2016 March, it's a safe stock in terms of debt equity, because it has taken debt, but it's not a lot. It's always 0.5 or less than that. But after 2016, it has taken debt, and it has been always above 0.5 after 2016 and up till now. So it's a dangerous stock. Now let's go to return on equity. We are looking for 8% or more than that for it to be ideal. Let's have a look. Please let me know if I'm going too fast. I'll slow down for you. Right now it's minus equity. So it's minus because the equity is minus. And so if I see previously, there are fluctuations, but it has always been above 8%. Just for once or twice it's less than 8%. So it's up to you to decide.